witness now. So we talk about supply chain management, costing and performance management, costing and performance management by Gary Cokins. Okay, so it's a action-packed 1 hour lecture. So just let me give a quick introduction to Mr. Gary Cokins. Okay, and Gary spent 15 years as a management consultant at Deloitte, KPMG, and EDS. So he dedicated 16 years to SaaS and a leading business analytics and intelligence software vendor, internationally recognized and expert speaker, author, and his focus is on enterprise performance management, business analytics, and then activity-based costing, and there are many things. So Gary wrote more than, I think, if I remember, more than 5 books, and he's expert in supply chain, accounting, and also the enterprise performance management and other parts of the business. Okay, so this is really a great opportunity for all of us to hear from Gary Cokins on such an important topic. So welcome, Mr. Gary Cokins. So thank you for joining the session today, and over to you, sir. So we are able to see your screen in a normal mode. Yeah. So, Mr. Gary.
Okay. Well, thank you again, Sheikh and Kuldeep and the rest of the team for inviting me to present again for the Supply Chain Summit. It's a long presentation and there may not be time for any questions and answers at the end. So my suggestion is, since there's my email address, send me an email directly to me with any comments or questions, and I will try to answer them within 24 hours. Also, you may want to view my website. Under the horizontal tabs, there are a lot of articles that I've written, and they're free. There's nothing to purchase from. I'm not in my website. I'm not selling anything. I'm just trying to basically help people, get educated. So let's go. Let's see if hitting my spacebar. There we go. So yeah, a little bit more. Who am I? Yes, my name is Gary Cokins. I received my Bachelor of Science in Industrial Engineering and Operations Research from Cornell University in 1971. My MBA from Northwestern University's Kellogg School in 1974. If you are doing the math, I am 75 years old, but I feel like I'm 45 years old. My career was kind of in 3/3. The first decade was with a large manufacturing conglomerate, FMC Corporation Link Belt. Yes, and as was just mentioned, consulting 7 years with Deloitte, 5 years with KPMG, and then with EDS, which was acquired by Hewlett Packard. And then for 16 years, I was with SAS. And people go, what's SAS? Scandinavian Airlines? No, SAS is actually the world's largest privately owned software vendor, 15,000 employees that specializes in data science and analytics. I was raised in Chicago, but I now live and have been for 20 years in the Raleigh, North Carolina area, which is where SAS is located. Okay, so why are those books there? I believe careers have a lot more to do with luck and circumstances than being smart and competent. I had 2 lucky breaks in my career. My first lucky break was when I was 27 years old. I wound up being a financial division controller with FMC. But after a couple of years in that job, I had the opportunity to become the operations manager in the facility. And I used the phrase, I then had to eat the accounting data I had been previously served as the controller bean counter upstairs. I found much of that information to be at best useless and at worst dysfunctional and misleading. And that was a wake-up call to me about the difference between external financial statutory reporting for government regulatory agencies and internal management accounting, including including activity-based costing that's used for insights and making decisions. Oh, I gotta get a sip of water here.
Yeah, I think you need to have a glass of water.
Did you say a glass of wine?
Glass of water.
Oh, yeah. Ooh, I haven't cleared it yet. Hold on, let me. Uh-oh. Oh, here it's coming back.
Yeah, it's
Next,
better.
a second lucky break was in 1988. KPMG struck an exclusive contract with Harvard Business School professor Robert S. Kaplan. And many of you will recognize his name from his work creating the strategy map and the balanced scorecard. But he, oh, wow. But he did the early pioneering work in activity-based costing. So I got recruited to KPMG to be trained by him for 5 years. I implemented activity-based costing, which we'll talk about. And then I wrote a book and it led to more other books. So let's go. Who will benefit from this presentation? Managers who have previously struggled at promoting enterprise performance management, supply
Right?
chain management, and
Gary,
integrating.
sorry, Gary. So it
Yes.
is, we are still looking at the first page. Is that? Mhm.
Oh,
So,
well, it's on my, I've advanced to my next slide.
yeah. Please, because when you share the screen, there are two things. One is the normal PowerPoint, and another is the slideshow. So we need to select
I'm
that.
in the slideshow.
Yeah. No, we are not able to see the slideshow now. We are seeing the PPT, PowerPoint presentation.
Okay, I'll get out of the slideshow. Do you see my slide with my bio?
And now we can see it. Yeah.
Okay,
Uh-huh.
I'll not use slideshow. I'll just use the slides regular. Now, do you see this title? Who will
Yeah.
benefit from? Okay,
It is.
so who will benefit? Managers who have previously struggled at promoting enterprise performance management, supply chain management, integrating their business analytics into their decision support systems. Managers who intend to champion any or all EPM, supply chain management, business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks has been my observation that although it's nice for senior executives to advocate, endorse new innovations and concepts and methods, often they are preoccupied with firefighting and short-term priorities. So it's typically managers 1, 2, 3 levels down in the organization chart who ask themselves, how long do we want to continue to perpetuate using arcane, stale, flawed methods? And they're the ones that'll do a pilot project or a proof of concept project to demonstrate to their coworkers and executives above them that this is the way to go. So if you're earlier in your career or further down in the organization chart, that's fine. I like presenting to you. I like to start with these 3 questions. What, so what, then what? So imagine you implement some of the methods I'm going to describe, including activity-based costing here in your organization. I say celebrate for 1 day. You are not done. You and your organization will see a lot more information than it's never seen before. Some of it will be contrary to your belief system. That begs the question, so what? What's relevant? Arguably, the most important question is the third question, then what? Because that's the future view, the result of decisions. We won't be talking about that in this presentation. That's another one about driver-based budgeting, rolling financial forecasts, what-if scenario analysis, decision support. So my agenda, I'm going to clarify the confusion and lack of consensus. What is this enterprise performance management all about? Describe why trading partners in the supply chain require collaboration. Then we're going to have kind of a primer on management accounting, briefly some of the stages that partner collaboration can be at. And then at the end, I'm going to share a frustration I have. What is taking so long for organizations to adopt these progressive methods? I love this cartoon, drowning in data, but starving for information. You have this poor beleaguered clerk, shoulders hunched, paper all around him, and the supervisor in the doorway to the left is asking him, looks like you've got all the data. What's the holdup? I gave you the request this morning. Why don't you have the answer this afternoon? And the message here is there's a difference between data and information. Data is collected and extracted transactionally, like from purchase order systems, invoicing systems, payroll systems, and the like. You convert the data into information, and you'll see how that applies next. Now, there is confusion and lack of consensus about enterprise performance management. Is it human resources? If you just do an internet search on PM, performance management, It'll be about the personnel and human resources function, employee appraisals. That's a subset. This is much broader. Is it about scorecards, dashboards, key performance indicators, measures, like the balanced scorecard from Kaplan and his coworker Norton? Yes, but that's a subset. And it similarly is it the aligning of the employees with the managers, with the strategy of the executives? Yes, but that's a subset. Is it about process, productivity, and quality improvement? Yes, but that's also a subset. That's business process management, BPM. Examples are lean management or Six Sigma, cycle time reduction, and the like. Or is it all of the above and even more? And the good news is this. The enterprise performance management methods all of you are probably somewhat familiar with them. You've read business journals or magazine articles about them. The problem is when organizations do implement them, they implement them in isolation of each other. So you've got cost and profitability reporting in one part of the building, you've got the supply chain replenishment people in another part of the building, you've got risk management people in another part of the building, planning, budgeting in another part of the building, and so on and so forth. You get a lot more power and synergy when you seamlessly integrate all of these various methods like gears in a machine, and even more power when you embed analytics of all flavors into each method, like regression, correlation, and so forth. So because I believe you've got a PDF of my slides, there's the paragraph of what I just described. It's the integration of multiple methodologies with each embedded with business analytics, such as segmentation analysis, but especially predictive analytics. And make no mistake, the purpose of enterprise performance management is to achieve the executive team strategy and make better decisions. So here are, if you will, 8 forces that have caused interest in enterprise performance management. I'm going to go through them very quickly, and then we're going to zero in on number 7. The first is executive frustration with strategy failure. Most executives are quite good at formulating strategy. Their frustration is failure to implement the strategy. And there's empirical evidence. There's an executive recruiting firm in Chicago, where I was raised, that monitors the involuntary turnover, firing of CEOs in North America. It's increasing every year. Next, increased accountability. Today, there is no place to hide. Managers and employees will be measured. They will be monitored. It doesn't necessarily mean that their job security is at risk, but it could adversely impact their salary increases or job promotions. 3, more rapid decision-making. Unlike a few years ago when you could test and learn, have meetings in conference rooms, today, managers, employees will be on the phone, go or no go, yes or no. They have to make a decision in real time. 4th, mistrust of the managerial accounting system for transparency and accuracy. The reality is most managers do not trust the accuracy of the management accounting system. Why? Overhead cost allocations, the bane of management accounting. I'll describe how we resolve that. 5, poor customer value management. Customers are the source of value, wealth creation for shareholders and owners. So we have to understand how the actions with customers impact the shareholder wealth. But the problem is the CFOs and accountants are not measuring customer profitability. They're stopping halfway down the income statement with just gross profit margin analysis. Number 7, our topic today, dysfunctional supply chain management. Briefly, and I'll get into it more, customers view suppliers as the enemy. It's an adversarial relationship. That's got to stop. It needs to be a marriage. Supply chains are competing against other supply chains. And finally, unfulfilled return on investment promises from large IT systems like ERP systems, enterprise resource planning systems like SAP, which many of you are familiar with and may be using. And the issue here is if you ask the IT director, the director of information, 2 years after you've gone through the long journey of implementing the ERP system, you ask him or her, how well do you believe the return on investment has met or exceeded what the ERP salesman sold you on 2 years ago? They'll be hard pressed to say yes. We put a lot of effort into this. I don't think we've got the payback. That does not mean you don't implement the ERP system. You have to, because your competitors all have it. But the issue is ERP systems produce a lot of data, but not information. And what the EPM methods do is they create the ROI like seeds from the ground. So, I got to use All right, let's move on to trading partners. Incidentally, I did co-author a book on supply chain with 2 university faculty from North Texas. If you go to wiley.com, I believe chapter 1 is a free download, so you don't have to buy the book. Don't accuse me, oh, Gary's trying to push his books. I'm not. Chapter 1 is a free download, and it's kind of a good summary of the entire book. So let's move on. Post-enterprise resource planning and supply chain management challenges. In the 1990s and 2000s and subsequently, businesses embraced ERP and supply chain management to automate relationships like with e-commerce and increase efficiencies. These either eliminated or shifted cost, but they did not address 3 key challenges. The first one that I already mentioned, adversarial relationships. While each trading partner knows there are mutual profits to be gained, decades of arm's length and adversarial behavior has precluded the efficiency gains. Next, procurement focus. There's immense pressures being placed on the suppliers for price reductions or containment without regard to effects on service levels. Some customers will say, oh, let's negotiate a much larger price decrease, with our supplier. If we put them out of business and they go bankrupt, so what? We'll get another supplier. That has to stop. There basically has to be this marriage amongst them, because if you put too much pressure on a supplier with price reductions, they may start reducing their services to you. Next, a suboptimal internal focus. It is no longer sufficient for your organization to be the most agile, lean, and efficient firm. You're dependent on all of your trading partners upstream and downstream in the supply chain to also be agile, lean, and efficient. And this eventually creates the need for collaboration, working together to identify mutually beneficial projects that'll save money for both of you, all of you. But first, you need to know the facts, to know what your own costs and profit margins are and who or what is causing them. So you may ask, well, then why, when in collaboration, why share financial data with your suppliers? They're the enemy. Increasingly, managers and employee teams must speak in the language of executives and the boardroom in the terms of money. Trading partners need to understand product, channel, and customer profitability upstream and downstream. When suppliers share their reasoning for the joint mutually beneficial improvement initiatives with their customers and suppliers using financial data, then genuine collaboration can be experienced. So now I've got to be a professor here and teach you a little bit about management accounting. But before I do, here's a quote from, and you may all be familiar in the US, Walmart is one of our huge supply chain companies. The retired executives said this: many companies may find it near impossible to track supply chain costs, but it is a requirement for properly tracking, reporting, and measuring item performance. And it is a true prerequisite for advanced supply chain and retail optimization. Also, Professor Doug Lambert, he's at The Ohio State University here in Ohio in the United States. He's very well known as a thought leader in the supply chain area. Here's his quote: every supplier should be running a profit and loss on each of its customers. You need a good contribution accounting system to trace the segmented cost. Next, its cost methods must widen beyond its 4 walls to encompass its trading partners as well. So visually, what we're saying here is, if here's a kind of a visual of the trading partners along the supply chain, the profit opportunities are there. The starting point is to measure profits across the supply chain and then identify those mutually beneficial opportunities. And it always begins at each seller-buyer interface along the chain. Now, to resolve all this, we have to use activity-based costing. And I know some of you have said, oh, I've heard about it. It's too complicated. It doesn't work. People can't understand it. It's too big. It's not maintainable. Those are all misconceptions, but sadly, they did happen. I'll tell you sooner in a few minutes how you could implement an AB system in 3 weeks, not 6 months. But what is ABC? Here's a way to understand it. Imagine you go to a restaurant with 3 other friends. You order a little salad. The other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other three say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. I mean, you order a little salad and they want you to split with their expensive meal. Well, what ABC does is basically it, and that's because the way they're that's how products also feel in a supply chain and company. When the CFO and the accountants allocate the overhead, which is more properly referred to as indirect expense, like spreading butter across bread using cost allocation factors like number of labor hours, number of units produced, sales amount, headcount per cost center or department, square feet, square meter. None of those cost allocation factors reflect the unique consumption that the diverse products and SKUs consume of the end-to-end business processes and the work activities that belong to those processes that in turn draw on the spending, the salary, the supplies, the utilities, and so forth. So if you were to divide the overhead into multiple cost pools, that's an accounting term, and then trace and assign each of the overhead cost pools with a cause and effect relationship, we call those activity drivers, you'll discover, compared to that butter spreading approach, in reality, some of the products were overcosted. The others must have been undercosted because it's a zero-sum error game. And that means that the CFO and the accountants are providing flawed and misleading information to the managers to make decisions. Oh, yes, their butter spreading does reconcile exactly to satisfy the external audit for the auditors and the government regulators, but it's wrong in the parts for making decisions internally. Why the interest in activity-based costing? It has to do with this diagram. It has the three universal components of any organization's cost and expense structure. It's got the indirect overhead at the top, direct material in the middle, and then the direct cost at the bottom. You'll notice what's happening is the indirect expense is displacing the direct over time. And when you ask managers why, they'll say, well, automation, computers, machinery, kiosks, that is secondary. The main reason the indirect is displacing the direct is over time, all organizations have had an increased proliferation of different types of products and manufacturing, more colors, more sizes, more ranges. And when you increase the diversity and variation of the outputs, it just produces complexity. And the complexity needs more and more indirect expense to manage it. So imagine if you, in the old days, you were a black pen company and all you did was black pens. Imagine what the warehouse would look like, a bunch of barrels of black ink and cartridges. Now imagine that you've got 30 colors, red, yellow, orange, green. Now imagine what the warehouse looks like. A lot of different barrels, a lot of forklift trucks moving stuff around. That's all indirect expense. So again, many years ago when it was homogeneous product, okay, well, most of the accuracy came from the direct. So you could butter spread the indirect. You didn't introduce that much error, but look to the right. That's not the case today. Now, the problem actually begins with this traditional responsibility-centered cost statement. Every manager on the planet Earth recognizes this report. But when a manager receives this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? And the answer is not much. I say when managers get this kind of report, they are either happy or sad, but they're rarely any smarter. And it's not that it's a bad report, it's just that the report is structured not in a way that can answer the question. Salary, equipment, these are all general ledger, accounts. What activity-based costing does is it converts that data, the 914,500, into the language of work. See, data now became information. So and then we do it in the language of work, key scan claims, analyze claims. Notice I'm even using the back office of an insurance company. It's a factory too. And incidentally, all these methods apply to service organizations similar to manufacturers and distributors. So like insurance companies, banks, travel agencies, they all have work activities. And then once we have the work activities, we reassign them to the products, SKUs, channels, and customers, just like the waiter or waitress in the restaurant. Oh, I'm not sure I gave you the definition. It's as if the definition, back to my restaurant example, is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume, what you purchase. You only pay for the salad. Now, I've rotated the previous diagram 90 degrees. It's not as simple as, oh, well, we take our ledger expenses, we can put them in these work activities, and then we sign them to products and SKUs. It's more complicated. The right side's more realistic. Why? Because you have support departments that support other support departments that eventually support the frontline departments that interact with customers and make products and deliver them. So it needs to be a multiple stage cost assignment network. Now, I want to warn you, the next slide is complicated, but the slide that comes after it will point you to a link to a 30-page paper I authored that explains this slide and others. There it is. It has the three universal components of any organization's expense and cost structure. We've got the expenses at the top, the salary, material, depreciation, rent, all that. We have the work activities in the middle, and then they eventually pile up in the bottom into the final cost objects, which is the cost of the products, the SKUs, the customers, and something called business sustaining. All of those arrows, think of them as thin straws or wide pipes, where the diameter reflects the amount of money that's coming through. That's why this will always reconcile exactly to the dollar, to the euro, whatever is the currency. Now I want you to look at the support departments. Notice that there's some activities that are not traceable to the products. They're supporting other support departments. That's why we're multiple stage. Also notice there are two red boxes in the people activities that are going directly to the customers, not to the products. And those types of activities are from, if you will, distribution channel expenses, marketing expenses, selling expenses, and the like. Business sustaining, there will be some expenses that have nothing to do with interacting with customers, making or delivering products, things like the legal department or when the accounting department is closing the books. So we create a cost object like senior management, and so we trace it to them. It's about 10% of a company's annual monthly expenses, but it is not allocable to the customers or the products. The bottom, think of that as the predator food chain. Large mammals eat small mammals, small mammals eat plant. So you can see that some of the costs are going to the products, but the customers are buying the products. So we would use the sales register for that. And I mentioned to you that was fast, and you probably said, oh, he's going too fast. If you go, when you get this slide, click on the link at the bottom. It's a 30-page paper that I wrote it's called the Statement of Management Accounting Implement ABC. I wrote it for an organization called the Institute of Management Accountants. I am a 30-year member. I've actually been a part-time role there as their executive resident. It's 180,000 members in 140 countries. They're everywhere. You have chapters of IMA where you live, and I wrote a lot of articles for them. Now, what's the consequence when you calculate ABC? The vertical axis here is the percent error. The horizontal line is from that traditional butter spreading, at labor hours, units produced, and so forth. The backward S curve is the calculation result from doing ABC. And what you discover, look to the left, is that for the simple products, they will have been overcosted by that butter spreading, labor hours and so forth. So it's actually hidden profit. And think of that as you in the restaurant ordering the salad. On the right side, we've got the complex products and services that require substantially more indirect expense. Well, they will have been undercosted. And it means you're actually losing money on those products and SKUs, but you don't know it. The consequences are severe. If you look to the left for the overcosted simple products, you'll obviously mark them up with a price 5-10%, but your competitors are going to say, wow, look how high their price is. We can price below that, so they're going to be stealing market share from you. On the right side, it's even worse. The sales force is going to be of the impression that some of the products and services they're selling are very profitable. They're not. In fact, some may be unprofitable. So the more they sell, the more you lose money. Now, here's another way of seeing the actual results from ABC, and you're looking at real data here from a real company. The vertical axis is the net revenues minus the properly traced and calculated ABC cost. The horizontal axis is the cumulative buildup of the profit, but it's ranked order from the most profitable product to the next profitable product or SKU, all the way to the end point at the right. The last data point, 2 million, will exactly reconcile with the income statement, 30 million in sales, 28 in expenses. This graph always looks like a humpback whale. In fact, that's the nickname for this graph, the whale curve, okay? And for this company, it was organization shock. It's always organization shock when the managers and teams see this, because in this company, they made roughly $8 million of unrealized profit revealed by ABC on 3/4 of their most profitable products. They lost $6 million on the remainder to net out at 2. And they can't believe it, because their belief is the graph is this little blue line. Oh, everything's profitable and there's a few losers at the end. And what's happening is all that broadly average, allocations was crushing any accuracy. It's like a heavy weight on the blue line. And what the ABC multi-stage assignment network is detects all of that diversity and variation, and it creates the black line at the top. And if you remember anything from my presentation, remember this, because it's about fact-based data. In the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss or the boss of the boss. So to the degree those executives are making decisions on intuition or gut feel or flawed and misleading information like the blue line, your organization is at risk. Incidentally, some of you may be saying, God, this is a really crummy looking slide that Gary's got here. The reason is this was my very first ABC implementation client with KPMG in 1988. It's almost 40 years ago I did this, and it's representative in any company even today. Now, some of you may be saying, Gary, you're starting to persuade me that we should be doing activity-based costing in our organization, but it would be a mudslide of excess data. Every employee would have to fill out a daily timesheet. They hate timesheets. It'd have 3,000 activities in it. The IT department would have to figure out how to extract driver quantities from our ERP system, so on and so forth. That is what people thought in the past. And as a result, they either refused to do ABC because they said it's not worth it, or they tried it and it was just too complicated. I came up with a method that implements ABC in 3 weeks. Here's how to do it. I start with a 1-day workshop with 5-6 cross-functional people in a room, build a high-level model very quickly with them using commercial software. You don't have to purchase the software then. And then the next morning, we bring in the other line managers, the executives above them, maybe board of directors. They see what was constructed by them, very engaging because it's your own company. The light bulbs go on with everybody. Oh, that's how we get rid of that butter spreading of overhead. Oh, that's how we can see our profit margins with layers like an onion skin. Oh, that's how we can validate if our pricing is correct. Oh, that's how we can do benchmarking with apples and apples, not apples and Oreos. They get it. So then a couple of iterations, improving the model, it becomes a system in 3 weeks. Make your mistakes early and often, not later when the system's hard to change. Let me also add, if any of you are listening to me are from a consulting firm, feel free to directly send me an email. What I enjoy doing now is training consultants and management and advisory arms of CPA firms how to implement these methods that I've been implementing the last 30 years. I feel I want to do knowledge transfer. My career's over. It's now basically a vocation, if you will, to help other people. The reason rapid prototyping works has to do with this graph. The vertical axis is the accuracy of what you want to know. Let's say it's of an SKU, a stock keeping unit, or a product. The horizontal axis is the level of administrative effort to collect the data, calculate the data, report the data. You'll notice you always get an asymptotic curve where it goes up very quickly and then levels off to the right with diminishing returns on extra accuracy for the extra level of effort of work. And the message here is stop at 95%. Don't put that much effort into it. Why try to do a little bit so much more to just get a couple of more, go from 95% to 97%. What's counterintuitive to CFOs and accountants, when I ask them, what do you think determines that black slope to make it go up steeply quickly? They think it's timesheets from employees. No, it's the multiple stage cost assignment network. That piping diagram I showed you 5-6 slides earlier is where the accuracy comes from, because it's detecting the diversity. It's really reflecting the consumption of everything. The message here is costing is modeling. Costing is not the T accounts and journal entries that the CFO and the accountants are familiar with. You're modeling the behavior, the impact of products, SKUs upon the work activities that draw on the spending. So I notice I say, is the higher climb worth the better view? Stop at 95%. This is management accounting. This is not external statutory financial reporting. Yes, for the CFO and the accountants, if they get the statutory external reporting wrong, they go to jail. But if they get the management accounting wrong, they don't go to jail. So it doesn't have to be so perfect. We have a phrase, it's better to be approximately correct than precisely inaccurate. It's better to be roughly right than exactly wrong. I love this cartoon. You've got this signboard, answers. To the left, simple but wrong. To the right, complex but right. Look how few are taking the right path. Most of the CFOs, and I have evidence that 95% of organizations that should be applying activity-based costing are not. They're doing it that bad, flawed way. That's all of them going to the left. And notice some are falling off the cliff. They're going bankrupt because they're using bad information to make decisions. Now, call to action. Today, the cost department of the average business is looked on as right arm of first importance in management. Without the cost department today, 90% of our business would be out of existence. The cost department of the future is going to have more effect on the business and on the general management of business than any other single department. And gentlemen, in my opinion, the major portion of the work of the cost department of the future is going to be applying recognized principles of cost analysis to sales expenses, for there is the greatest evil in the present day industry, the high cost of extravagant, outrageous cost of distribution. And look at the date that this was written, 1921, over a century ago. I like that where Khalid in his presentation that just preceded me, he said, you really need good analysis, basically to a cost analysis to basically be competitive. So let's talk about customer profitability. The only value a company will ever create is the value that comes from its customers, the current ones and the new ones acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, and make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we have a problem. The accountants are not calculating customer profitability. They're stopping halfway down the income statement with just gross profit margin analysis. So what about the calculated cost below? Products and standard service lines are not the only thing for which accountants should compute costs for. What about those costs that have nothing to do with making the products and delivering them as services? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. And I'm going to make a case why the bottom half, the channel, distribution, marketing, selling, is more important than the top half. The products tend to be commodities. You get it through specialization, with special services. Here's a fictitious income statement. You can see that the gross profit margin is 70, but then below that are, a lot more expenses, selling, distribution, and marketing. We need to get visibility to that. Visually, what I'm showing you with this diagram is the rectangle. The big rectangle is let's say you're spending for the month of January. The accountants are only calculating for the shaded spot. And it would be nice if they were allocating the indirect expense with ABC, but they're not including distribution, sales, marketing, and general and accounting. We have another problem, angel customers and demon customers. What do I mean by this? Every company has high and low maintenance customers. Example of the high maintenance customers, the demons. They're always changing delivery schedules, always demanding special, not standard products, always returning goods, always calling help desk. The low maintenance customers, the angels, we love them. Never change schedule, only buy standard, never return goods, never call help desk. If those two types of customers at polar opposites, but the same volume, same mix, same price, they're not equally profitable because the high demanding demon customers are causing so much extra work and cost, and therefore it's reducing your profit. So the message here is sales volume is not synonymous or equivalent to the profit from a customer. What I liked, caught attention of this book was its subtitle, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. So the message here is we want to connect the actions with our customer to how it basically results in higher profits and wealth creation for the shareholders and owners. Incidentally, this book was by two university faculty at Columbia University in marketing. There's not much about it in management accounting. Now, profitable and unprofitable customers are distinguished by how they place demands on the work activities. Let's look at the angel customers to the left, the less profitable, or the high demanding ones, the demons. Small order quantities, special products ordered, heavy price discounting, unpredictable demands, always changing the delivery times, high technical support, slow payment. Now to the right, the angel customers, we love them. Large order sizes, only ordering standard, little price discounting, maybe none, predictable demands, delivery times always standard, low technical support, maybe no technical support, and then they pay on time. This can be measured with activity-based costing. Now, I've decomposed the multiple stage cost assignment network. It's in that 30-page paper, but you can see that the activities are coming in from left to right. Again, typically 60 to 70 activities in an ABC model. As each one piles in, the layer of profitability is being stripped away, and this allows us to get to a profit and loss statement for each individual customer, and the profit margins are visible like a layer of profit, like an onion skin. You can see 50, 60 layers, not just two simple ones. And in this fictitious case, the company had a 30% composite average gross profit margin. Between the 30 and the 8, 22 more points had nothing to do with the product making an SKU. It was all the delivery, marketing, and selling. So if we calculate these two broad swaths for every customer, we can put them into a chart that looks like this, where each customer is a circle intersection in the grid. The vertical axis is the product mix gross profit margin above the line, and the horizontal axis is the below the line, the cost to serve, the distribution of channel expenses, marketing, selling, cost to serve. And now things become obvious. The most unprofitable customers are in the bottom right, because they're buying low profit gross profit margin from you and they're difficult to serve. The most profitable customers are in the upper left because they're buying high profit margin mix from you and they're easy to serve. And now the action and the name of the game, move the dots from the bottom right to the upper left. And that could be done like with cross-selling or upselling. You know, if they buy a set of golf clubs, can I sell them a golf shirt? If they buy the golf shirt, can I sell them a second shirt? Oh, we could do fee-based, unbundling. The banks have been doing that for quite a while with depositor cards. The airlines, look, they charge you a fee for baggage. They'll charge you a fee if you want to move from a middle seat to a aisle seat. So for all that extra work, charge your customer for it. Now here's a chart that is similar. Instead of circles for the customers, now there's squares. The vertical axis is how profitable is the customer. The horizontal axis is now the sales volume. So you notice the square to the farthest right, that's our largest sales customer. Up above them is a little less sales, but even more profitable. Look how many customers are in that shaded triangle. They are unprofitable, even though they have substantial sales. So what's really happening here is there needs to be a shift in the CFO's emphasis. They need to start helping sales and marketing to better target customers. Typically, what's the CFO and accounting doing? They're pounding on operations, get your costs down. No, they need to help sales and marketing. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits. This means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back, and which types of customers are not attractive? And for the customers that are attractive, how much should we optimally spend attracting, retaining, growing, or recovering each customer micro segment? And the reason I have optimally in italics is because it is an optimization problem. Why? Because you can overspend on certain customers needlessly, but you can also underspend on them. In fact, let me explain what I meant by that. Remember the subtitle to the book, Discover Which Type of Customer is Which and Turbocharge Your Stock Price? Well, you can destroy shareholder and owner wealth in two ways. The first is overspending unnecessarily on loyal customers for what is needed to retain them. They would have bought the same volume mix from you regardless, so you wasted a lot of money by giving them special services. But you can also destroy shareholder wealth by underspending on marginally loyal customers, maybe not even loyal customers, and risk their defection to a competitor. So, you don't giving them any interest, you don't care about them, they're going to go to a competitor. So it's like the Goldilocks, if you're familiar with the fable, there's an optimal level, not too much, not too little. The accountants can provide this information, but sadly, most of the accountants don't. You can probably tell I'm being critical of the accounting community. Most CFOs and accountants are in the 1970s. How do we get them into the 21st century? That's really a challenge for all of us. Now, there is a way to also see the process view of costing. This is a simplistic example of the multi-stage cost assignment. Notice the X's in the departments are the work activities. And then I showed you how we trace and assign them to the products, the types of orders, types of customers. That's used strategically for profit margin analysis. But the process people, the lean management, Six Sigma, they may say, I don't really care where we make or lose money. That's really up to the marketing and sales executive team. But I do care about process improvement, cycle time reduction, improved quality. Well, we can take the activity costs in the middle of the ABC system and string them like pearls horizontally. And if we do that, then we can create what's called a value stream map. So what you're seeing now is the horizontal view of each of those activities. The height of the stack is how much each activity costs. And then what the lean management people do is they tag or score each work activity as value added or non-value added. I'm kind of using kind of a continuum. And so the larger amount of non-value added in an activity, then they'll focus on it to mitigate it, to reduce the cost, improve the cycle time, improve the quality. So ABC information can be also used by the operations people in addition to marketing, sales, and strategic people. Now, this is a diagram that I created for an organization called the International Federation of Accountants. They're in New York City, about 50 employees. What IFAC, and you can go to their website, ifac.org, they're like the United Nations of Global Accounting Institutes. There's about 150 global accounting institutes. In the United States, it's the AICPA. In London, England, it's the CIMA, Chartered Institute of Management Accountants. Back in the US, Institute of Management Accountants. And I told them I can create a taxonomy, like in biology, plant kingdoms, animal kingdoms. And you're seeing the taxonomy. There's three big kingdoms of accounting: tax accounting, financial accounting, managerial accounting. Now let's follow down. First of all, see where it says cost measurement? This may surprise you, but expenses and costs are not the same thing. Definition: expenses are when the organization exchanges money with third parties, meaning like pays suppliers or pays employees through payroll. Costs are always calculated. So a process cost, an activity cost, a product cost, you calculate the cost. So notice we start with calculating the cost. Now to the left becomes the external financial accounting. GAAP stands for Generally Accepted Accounting Principles. So this is what the CFO and the accountants are basically complying with, all of these, if you will, regulatory rules. But for management accounting, we don't have to follow those rules and those assumptions. We're going to model it using the activity-based costing network, and that gives us cost reporting and analysis. Spending, budget variances, profitability reporting, process analysis, the things I showed you. Now, if you look to the right, and I'm not talking about that because there's not enough time in this webinar, there's the decision support and cost planning. Now we're looking through the windshield, the future's coming at us, next month, next quarter, budgeting, planning. And that's where we can do driver-based budgeting, driver-based rolling financial forecast, what if scenario analysis, and the like. It does mean you need to think like an industrial engineer, because when you do the predictive view, you have to classify the behavior of the resources, a sunk fixed, step fixed, variable. It really becomes microeconomics. Now, engineers understand how to do this, but the accountants typically do not. In fact, let me explain that. On the left side is the descriptive view, last fiscal month, quarter period. So that's where we traced and assigned for the profitability strategic. But to the right side, for the predictive view, as the future comes at us, new customer orders, you'll notice what's happening here is the variable is getting larger, the fixed is getting smaller. What's really happening is when we classify the behavior of the resources, sunk, fixed, step fixed, and variable, what we discover is, for example, we can replace full-time employees with temporary contractors and then make them variable. Or we could lease assets that we normally would have purchased and then incurred depreciation. So you really have to think like an engineer. In fact, I always tell people I've been in the CFO accounting space since, the age 27, but I'm still an engineer masquerading as an accountant. Now, stages. There are 3 stages of collaboration. 1, both parties recognize the power of collaboration with the senior executive support and encouragement, while acknowledging it will take a lot of time and effort. Stage 2, both parties have supply chain strategy with collaboration as a core element. Work together enough to develop trust, to openly share data, strategies, mutually plan to sustain the effort. In stage 3, both parties mutually develop jointly agreed on key performance indicators, measuring success against the targets of the KPI indicators, and equitably sharing the savings for better fill rates, lower inventories, lower costs. I want to give you an example of a mutually beneficial cost savings. Imagine that there's a receiving department for a company from a supplier, and it's on a skid that's all wrapped together with cellophane. And it's really difficult. It takes them a long time basically to undo that skid. If they had a meeting with the shipping people of their supplier and shared that, the supplier may say, well, wait, we can put this on a skid ready where we've got imprints where we can put our parts into. And when they get to your receiving dock, you just lift them off. Notice time and effort was reduced, both the supplier and the receiver. That's an example of a mutually beneficial project or initiative. Now, my big frustration, what is taking so long for organizations to implement these methodologies? Well, what are the barriers? The first one are technical barriers, and they are IT related, such as we call it dirty data. So, maybe the people entering the information into the transaction system, they've made mistakes or typos. But there's a tool that IT has called Extraction, Transform, and Load, ETL. And it's like a water purifier. Let me give you an example. Let's say you're a large conglomerate and you want to basically do a volume discount, price discount with a large supplier, General Electric. But in the different divisions, one of the divisions in the vendor master file, they put in GE for General Electric. Another division puts in GEN apostrophe L, General Electric. Another spells it out. So to the consolidated system, they look like 3 different suppliers. The ETL system will standardize. Let's say it's on General Electric full word. It'll replace it in all of the vendor master files. Then you do the calculation, and guess what? The people at headquarters can now have all the facts and information to go negotiate with General Electric. We buy a lot from you. We want a price discount. The second barrier is that perception, excess complexity and affordability. They think, oh, it's too complicated. It isn't worth the effort. I already showed you with rapid prototyping, with iterations, you can implement in 3 weeks. But the biggest barrier has got nothing to do with technology or software or methods. It's about people. And it starts with resistance to change. It's human nature. People like the status quo. People don't like change. Don't rock my boat. Only babies like change, with diapers. But other barriers, fear of others knowing the truth. Oh, I don't want the other departments to know what my costs are. Fear of being measured, fear of being held accountable, weak leadership. There, I said it. Not every executive team's got the highest IQ, so you're going to need soft skills, behavioral change management skills to successfully implement these various methods. So your success depends on how well and how fast the right information and intelligence gets to the right people. Now, I wanted to basically explain that unfortunately what's happening over time is there's a shift from of return on investment from tangible investments to intangible investments like information. So if you can imagine a graph with an exponential curve from left to right, it's swooping up like going up a mountain. That think of the horizontal x-axis is going from data to information to insights to better decisions. Okay, but the problem is most organizations are stuck at the very left with only standard reports, if you will, all and raw data and standard reports, like from an from an ERP system. All that the managers and employee teams can answer is what happened. Now, in some cases, the IT director will give some of those employees and managers what's called business intelligence software, drill down software, like SAS, my previous employer, or Alteryx or Snowflake. These are different, if you will, data science software vendors. And then a manager can drill down to look at an anomaly or an exception, like why is that purchase way out of typical? But they're still restricted to only answering what happened. What the enterprise performance managements do is they start basically providing with modeling and cause and effect relationships, giving you the information. Why did it happen? It gives you an explanation why different things are more or less profitable. And then when we go to the predictive view, the future coming at us, we can do sensitivity analysis, we could do what if scenario analysis, so not only can we look at, why did it happen and what can be done, we can look at what are the possibilities that can be done. And ultimately, at the very highest, we call it prescriptive analytics, optimization of all the choices we could make. What is the best choice to make? So thank you very much. There is we've got 6 minutes. There may be time for Q&A. Again, I want to repeat, if you go to my website, go along the horizontal tabs under it are articles I've written. Also, those of you listening to me, you're welcome to invite me to connect in LinkedIn. But if you do, I appreciate if you would do the optional message that says, Gary, I attended your Data Labs India, webinar, so I'll know, who you are. So let me hand it back to the Data Labs team. How do you want to use the next 5 minutes, or we could stop?
So thank you, Mr. Gary, for wonderful lecture as usual. So it is so kind of you to join early morning and giving a wonderful lecture for the audience. Okay, it's very important topic, how to use the enterprise performance concepts in supply chain management context. So that is really amazing session what we had. Okay, so
can you still hear me? Because I seem to have gotten out. Yes
yeah,
or
yeah,
no?
we can hear you, sir. Yeah.
Okay, I'm not going to touch a thing then. Okay.
Can hear you. So what is the key takeaways for 2025, considering the technology evolutions and business process evolutions, what is happening across the globe now? So what is the key takeaways? What do you advise for supply chain managers to do in 2025? Mm-hmm.
I think you need to spend more time with your CFO and the accounting team. You need to demand better information from them. As Khalid said presentation before me, you need a good business analyst to do stuff. But that analysis can actually be done by the supply chain people and operations people. They've got brains, but if you don't have good data or information, then you're not going to be able to make good decisions. I have a phrase, ready for this? In the land of the blind, the one-eyed man is king. I'll say that again. In the land of the blind, the one-eyed man is king. Most supply chain managers, when it comes to the accounting information, they're like in a dark room. What the ABC does is like turning a light on in the dark room, and now you can see things that you hadn't seen before and start making better decisions, start seeing where things are disarrayed. So that would be my advice for the supply chain team. Are there other questions?
Yeah, so I think there are no questions put up by the audience.
Then I have a closing remark,
Yeah, please do, sir.
and then I'll say goodbye and thank everybody. I believe in the past, the best leaders and best executives had the best answers. Today, I do not think that is the case. Today, I think the best leaders and best executives have the best questions. Why? There's too much complexity. There's too much volatility. There's too much uncertainty for them to rely, those executives to rely on their sixth sense or their intuition or their gut feel or the types of answers they had earlier in their career that got them promoted to the top executive levels they're at. What those executive leaders need to do today is basically ask questions. They need to create a culture of investigation and discovery and tolerance for making mistakes, as long as you learn from the mistakes. So I think the key, even in my career, I've learned, rather than just lecture to people, oh, here's how it works, I try to first create some discomfort in them by asking kind of uncomfortable questions. Are you measuring the right things? Do you know where you make or lose money? Do you know which customers are more or less profitable? Notice if you ask an executive that question, you're going to make them a little nervous. Well, you may be job threatening, And once they start saying, "Yeah, we don't know that. What will we do?" Then you come in with, "Well, here's the solutions." And if they think your solutions like ABC are overly theoretical or impractical, then you can solve and say, well, but we have practical steps we can be implemented in 3 weeks. So I'll end on that note. Again, Sheikh, Kuldeep, Data Labs India, Fruition, thank you so much for inviting me to present again.
Thank you very much, sir. Thank you very much. So have a great time and have a great weekend. Yeah. So thank you. Thank you very much. Okay. So we had a wonderful session on EPM concepts and application of EPM and activity-based costing in the supply chain management domain from Mr. Gary Cokins. So it is wonderful lecture, and we are happy to have Mr. Gary Cokins on the board.